Welcome back, folks. Greg Silverman here, your Chief Investment Officer. If you'd like to see more of our private investment platform, take a look at the link below to Ridderband Invest. We do these curated articles. We put them out. We see which ones everyone likes, and then we'll do a read me session. So this is like a come learn with me. We call it the come learn with me session. We have other programs like looking over the manager's shoulder, where we bring on managers and investments and companies and interview them. So check out the links below. But with no further ado, let's have a look at this one. Will investor due diligence uncover your firm has these business risks? Okay, let's make this a bit bigger. Investor due diligence. Sophisticated investors do not want to take on significant business risk exposure when allocating to an emerging manager. Such investors understand that business risk is different from strategy risk. Their strategy risk evaluations have much to do with how sound investors perceive the investment process and the intellectual acumen of the portfolio manager. In contrast, their business risk evaluations have much to do with the perceptions about the emerging manager firm's owners, whether they demonstrate having small business owners' heads on their shoulders. Here, the issue is how likely does it appear that the firm owners can grow the business enough to cover overhead expenses, support ongoing growth, and then generate a profit. Until that point, a money management firm's longevity remains a question and an uncertainty. So they're talking about the money managers. All right. AUM is the key at-glance data point that raises the specter of potential business risk in the minds of sophisticated investors, even those who are prospective seed investors. The smaller money management firm is in assets under management, the greater the likelihood that a sizable investor allocation to the firm would be the or a major allocation. Therefore, a primary factor that reduces an investor's business risk exposure to an emerging manager is growth of assets under management, particularly where allocation comes from new investors. This is not just a matter of having a larger AUM, it's having a larger and therefore more diversified investor base. As more investors come on board, the financial risk of one or two investors pulling their allocation becomes less of a business risk. So how do sophisticated investors in their due diligence look to determine how much of a business risk an emerging manager firm presents? They only need to decide how lacking they find a firm in regard to 5 factors. Okay. Sorry, I just want to go through those factors. All right, let's go. Lacking the capital to run business. The emerging manager needs to have a war chest large enough to fund running the business for a minimum of 2 years. Correct. Anyone with less than that needs to realize that while friends and family may be willing to risk making an allocation to such a portfolio manager, a few sophisticated investors would. Few. Lacking investment in the fund by the portfolio manager running it. There are 2 ways an emerging manager firm demonstrates having skin in the game. The first is in funding business operations, and the second is investing in their own strategy. Owners of small money management firms may have allocated most of their savings to funding business operations, and that's fine. But it helps to have at least a token allocation to the strategy that outside investors are being asked to invest in. Lacking the gumption to run the business. Sophisticated investors look for emerging managers who are clearly comfortable in betting their livelihoods on their abilities. Those who aren't show it. For example, every year I get a phone call from some startup managers who during this conversation admit that their plan is to give it a year and see if they can land some good-sized investors by then. If so, they would invest those revenues from these early big believers into running their business because they did not have enough of their own money to run an institutional investor caliber operation. If not, they plan to shutter the business and give back the assets allocated by the investors who took the chance with them and did invest. Such emerging manager firm owners lack the confidence, drive, and desire needed to succeed. Sophisticated investors look to weed these people out when conducting their early stage due diligence. So too does my financial communications and sales marketing consulting firm. We will not work with such emerging manager firm. A little plug there. Lacking detailed communication and marketing action plans for raising assets. How does the emerging manager firm plan to reach the prospective investors, educate them about how it thinks and invests, supply them with the details their investment committee members need to decide whether to allocate? This is a business risk question sophisticated investors ask. They appreciate that the number one factor that most often closes down emerging manager shop is not a trade that blows up. It is lack of success in educating and persuading enough people to understand and buy into how the firm invests. Giving comfort factor to prospective investors about how a firm is aiming to address the asset raising requires delivering a thoughtful and detailed response about how the owners plan to handle both communications and sales marketing. 2 separate things need to work in tandem in order to successfully outmarket competitors and win new allocations. Lacking a business plan, spelling out how management aims to reinvest its revenues in the business. Here, the firm owners need to communicate their thinking on issues such as what business operations tasks will be outsourced, which will be intended to be handled by in-house staff, and when, at what point might it be affordable to hire such in-house staff members. This can cover the gamut from trading and compliance to IT and sales. Also, emerging manager firm owners, will find themselves being asked what plans are to add to portfolio management staff with the aim of training someone to be able to fulfill the role of co-portfolio manager. This goes a little toward lessening perceived business risk from the hit by a bus scenario often brought up in regards to one-person money management firms. Make an effort in your marketing to demonstrate to prospective investors that your emerging manager firm is not lacking these 5 areas. Reduce concerns regarding these types of business risks, considerations, and you can redirect your prospects' attentions back to the primary things you have to sell, the intellectual acumen of management driving the strategy you create. Very sound article for those of you looking to invest and do due diligence with managers. If you like these kind of articles, there's more of them on our YouTube channel. Please subscribe and like, and check out some of the links below, and you'll see some of the investment themes that we are focused on right now. Thank you for joining me. Greg Silverman out for now.